Stock indices in the Asia-Pacific region are down today, despite better than expected economic data from China and a reversal in oil prices that's expected to ease energy costs. Investors are grappling with a worsening of the latest COVID-19 outbreak in China. Toyota, Volkswagen and Apple's supplier Foxconn are among dozens of companies that have halted operations after restrictions were extended to include more than 50 million people on the mainland. Expectations of lower fuel demand have driven oil prices down by 5%. Meanwhile, Russian officials have said that talks with Ukraine have made progress, driving some hope of a resolution to the conflict. But market activity throughout the rest of this week will likely be driven by statements from the US Federal Reserve. It's expected to share its outlook for the world's largest economy and begin hiking interest rates to rein in inflation. For more on this now, Craig Erlam is joining us now from London. He is OANDA's senior market analyst. Many thanks for being with us today. Craig, first of all, on this last point, the much-awaited Fed meeting, what are you expecting from today and from tomorrow? I mean, a quarter of a percentage point increase is likely. Are you looking at a potential half of a percentage point increase?
I think a half a percentage point would be extremely punchy, given the geopolitical backdrop and the amount of uncertainty which comes with that. We have to remember that the slowdown across Europe is a result of what's happening in Ukraine, on top of the movements that we've seen in commodity prices, which are massive economic headwinds, particularly in the energy sector. That has to be taken into consideration by the Federal Reserve. So the idea that we could see a half percentage point increase seems a little far-fetched to me right now, and I actually think it would be a policy mistake. I think what the Fed should do and what the Fed will do is raise by a quarter point now or tomorrow, and again at the next two meetings, getting interest rates back towards 1%, and then in a position when in the middle of the year, once we hopefully see inflation peak and we know a lot more about the outlook in terms of the economy for the next couple of years, the situation in Ukraine, when they have a lot more information to hand, then they can start to make different policy decisions. That may mean ramping up rate hikes, maybe doing half a percentage point then, but at least they'll do that without a foggy outlook. And I think that's the important thing here. I think what the markets need to see today is, one, what the interest rate hike is going to be, and two, what their outlook is going to be against such an uncertain outlook. We have to remember the markets are pricing in 5 more rate hikes after this week from the Federal Reserve this year. That seems, again, extremely punchy to me.
Interesting, Craig. Yeah, and if you say 5 interest rate hikes this year, if it were to be a quarter of a percentage point increase to start with tomorrow, how do you think stock markets, but most importantly bond markets, would react to that?
I think that's really what the markets are expecting. So I think that would fall very much in line. The important thing tomorrow is not necessarily what the Fed does, assuming they're not overly aggressive. The important thing tomorrow is what they signal and what they say about the uncertain outlook as a result of the geopolitical backdrop. I think that's the most important thing as far as markets are concerned. The key point here, though, is that if the Fed is seen to be pushing back against interest rate hikes and using the geopolitical backdrop and the uncertain outlook as a reason why they need to go slow and gradual, I'm not necessarily sure the markets will pay too much attention to that. We've seen in central banks now for many months pushing back against interest rate hikes, and the markets have generally disregarded that. But what we have also seen is when central banks have embraced rate hikes and become much more hawkish, then the markets have become much more aggressive again. So that's, I think, where the risks lie as far as the markets are concerned.